All right, so this starts our supply and demand module. But before we get started, I just want you to know that most of the things that you see in my courses, even starting with Ichimoku, price action, fractals, none of that is invented by me. It's just that I use those things and master those things and then trade those things in a different way than other traders they may trade. Right, therefore I get my own concept. So when we start talking here about supply and demand, it's not a concept that's developed by me. And most of the things that I talk to you about, you can find online just as much as the pretty much same thing with a lot of the course stuff that I talk about with Ichimoku. But trading it the way that I trade it, you will not find that online. So these concepts were not invented by me, but the main person that really started showing how to trade supply and demand was a trader named Sam Seaton, and he's from OTA, which is the Online Trading Academy. So he's really the one that I know that really started the trading of supply and demand. All right. So when we talk about supply and demand, traders often confuse this concept with support and resistance. There is a difference between the two, but I do believe supply and demand creates support and resistance. So in order to understand the differences, we need to understand the concept of each. Supply is an area or zone where there is an increase of selling pressure. When price reaches the zone, sell orders outweigh buy orders, causing a supply imbalance, which means sellers enter the market and outnumber the buyers, causing price to go down until buyers become interested again and drive price back up. Resistance is an identified maximum zone or an area where the supply has exceeded the demand, stopping the rally and causing the price to drop. Therefore, a supply level is synonymous with a resistance level. And then a demand is an area or zone where there is an increase of buying pressure. When price reaches the zone, buy orders outweigh sell orders, causing a demand imbalance, which means buyers enter the market and outnumber the sellers, causing price to rally until sellers become interested again and drive the price down. Support is an identified maximum zone or area where the demand has exceeded the supply, stopping the fall of price and causing the price to rally. Therefore, a demand level is synonymous with a support level. Pretty much the same that I just said, but opposite, if you understand that. Supply and demand creates market equilibrium and market disequilibrium. The point at which supply and demand are equal is known as market equilibrium. This point represents the price at which the quantity demanded by consumers is equal to the quantity supplied by producers. This is the ideal outcome in the market because the most efficient producers are sellers and those who are most willing to pay are the buyers. Market equilibrium maximizes both consumer and producers' surplus and extracts all potential gains from the market because both sellers and buyers are contributing to the market at near equal amounts, keeping the market stable or within a range. And that's the ideal market. At this point, if either buyer or sellers outweigh one another, the market begins to move away from equilibrium and into disequilibrium. A situation in which the market of an asset is exactly equal to its demand is called market equilibrium. Since there's neither surplus nor shortage in the market, price tends to remain stable in this situation, though creating equilibrium. So to illustrate how supply and demand interact to determine an ideal exchange rate in the Forex market, I'm using a standard supply and demand graph. Now I got this graph offline and I did some changes to it and made it my own because basically I see things a little bit different, so I wanted to show you something based off of a graph. So supply is represented by a yellow solid diagonal line that is directed up from a low point at the left to a high point at the right, and the demand is represented by a blue solid diagonal line that is directed down from a high point at the left to a low point at the right. The Y or vertical axis represents price. The X or horizontal axis represents the quantity of supply and demand. And finally, the ideal exchange rate is represented by the point at which the two diagonal lines intersect. So in this case, you'll see on the next slide that the supply and demand graph indicates that the ideal exchange rate for the Euro-US dollar pair is 121.50, because that is where both lines intersect each other, and that is where you have the same amount of equilibrium. Pretty much that's where you have market equilibrium, 121.50. So as we said, the ideal exchange rate is represented by the point at which the two diagonal lines intersect, and that is the ideal exchange rate at this point. So supply is represented by this yellow line and demand will be represented by this blue line. So as we discussed, as supply increases, the ideal price decreases. All right. You will see in the next illustration that as the diagonal supply line moves farther and farther to the right, illustrating an increase in supply, the intersection of the two lines moves lower and lower on the y-axis. This tells us that the ideal exchange rate is getting lower and lower. And you could see as they both move lower, you could see the ideal exchange rate has changed from 121.5 now to about 120.2 or somewhere, 120.25, somewhere in there. So conversely, as shown in the next illustration, as the diagonal supply line moves farther and farther left, illustrating a decrease in supply, the intersection of the two lines moves higher and higher on the y-axis. This tells us that the ideal exchange rate is getting higher and higher. And you can see how it increased, and we're pretty much near the ideal exchange rate is almost 122. Moving the diagonal demand line left and right will have similar effects on the exchange rate. As demand increases, the ideal price increases. So when you move the diagonal demand line further and further right, illustrating an increase in demand, the intersection of the two diagonal lines moves higher and higher. So you can see as I move this further to the right, the demand line supply increases, and you can see the ideal exchange rate is now above 122. You can also see in the next illustration how when you move the diagonal demand line farther and farther left, illustrating a decrease in demand, the intersection of the two diagonal lines moves lower and lower. All right, you can see as we move to the left, the demand line, the exchange rate dropped. So we're pretty much near 120.5. So the instance in which you see a dramatic shift in the ideal price level comes when both the supply and demand lines are moving. For instance, if demand or currency suddenly increases while supply is decreasing, the ideal price level will climb very quickly, as shown in the next illustration. And you can see the ideal exchange rate is much higher than 122 at the moment. As you can see, we had an increase in supply and we moved the demand line more to the right. You can see what happened. On the flip side, if demand for a currency suddenly falls off while supply is increasing, the ideal price level will fall just as quickly as shown in the next example. Supply and demand work efficiently in tandem. And here you could see how price dropped off, how the exchange rate dropped a little bit below 120 here. All right, so now, how do we know supply is in it? So now that we know that supply is an area or zone where there is an increase of selling pressure and demand is an area or zone where there is an increase of buying pressure, we now have to understand and learn how to spot these zones and then how to trade these zones. So basically we're not getting super deep into what supply and demand zones are based off of the what you would call a zone and how you would spot a zone. We're not that deep into exactly what a supply zone is. We just have a basic understanding here. So we're pretty basic, but that's all we need to know. So right now we want to focus first on how to spot those supply and demand zones. So a zone is an area where price has consolidated for a short period of time and then price explodes away from the consolidation. This zone will be called the base. The base can consist of at least one candle, but preferably not more than 6 candles. So if you had 7 or 8 candles, would that make a difference? No, I would still consider that one that you would trade. All right. So we don't want price to sit at the level for days upon days. We have 4 kinds of supply and demand zones. So we're going to have a drop base rally, which is a DBR, a rally base drop, which is a RBD, a drop base drop, which is a DBD, and a rally base rally, which is a RBR. So here's a drop base rally, which is also a reversal. So drop would be one leg down. Here's your drop. Base would be your consolidation zone, which is this, and then rally would be your second leg up. That would be the leg there, all right, which would be a reversal. And then we have a rally base drop, which is also a reversal because you have a rally which would be one leg up, and then your base would be your consolidation zone, and then the drop would be your second leg down. So you'll understand this more when we look at the live charts coming up shortly. All right, and then a drop base drop is going to be a continuation pattern. So you have your one leg down, which would be your one leg here, which would be your drop, and then your consolidation leg, which would be your base, not your consolidation leg, but your consolidation, which would be your base, and then a drop leg, which would be your second leg down. All right. And then your rally base rally, which is also a continuation, would be a rally leg up, consolidation, and then another rally leg up. All right. And remember that consolidation can consist of 1 candle or 6 candles or 8, somewhere in that area, but you don't want to be 15 candles. You don't want to consolidate for days. So how to identify supply and demand? Here's your rally. Here's your base. You can see we based, and then here's your leg drop. So this is a rally base drop. All right. And then I drew a supply zone. I have a distal line and a proximal line. First touch and price drop. So you could see where we drew the zone here based off of the rally base drop. So where we had that consolidation right here, that's where we started to draw our zone. Once we draw our zone, then the market drops, and then the market came back to the zone. So we'll get deeper into these zones and how to trade these zones. All right, so this is a drop base rally. Basically, the market dropped, then it based, and it only based for 1 candle and took off. So that was a drop base rally, and then as price comes back to that level, however long later, a couple months later, 6 months or so, this level price touches and then moves to the upside. You get a second touch, and then the market really takes off, giving you a very good trade off of this supply and demand zone. This would be a demand zone. So demand zone is going to be pretty much where you would find your support and your support zone. As remember I said, demand is synopsis with supply. Now here you have, this is also a rally, a base, and a drop. So this is the rally to the upside. This is my base, these 2 candles here, 1, 2. All right, and what I did, when you're looking at this zone here, I drew from the wick to the upper top of the body. But when we're looking at this zone here, which is a supply zone, we'll be more concerned with the upper wick and not the lower wick. So we could draw the base. We could draw the zone at this level right here. All right. So you could draw it at the base of the candles. And then now what we're looking for, say we didn't draw this level here. We waited, price was here. Now we draw this level because we see it and realize it. Now we're waiting for price to come back to this level. When price comes back to this level, since it's a supply zone, price should drop because this is where sellers will be entering the market. That's where we're going to have our entry order. All right. So here it is again. The market rallied. You had a base and then a major drop. And then this happened around February, and then coming back, we look here and you got your second touch 7.5 months later. Prices come back to the zone and drop. So basically in October, so from February, we waited all the way till October for this trade to be identified and trade this to the downside. All right, and this is a daily time frame. You're going to use your higher time frames to have more higher probability trades, which are going to be more reliable with the higher time frame. So daily on, I would at least use a daily, but you can use a lower time frame, and the same things apply as we're showing here. All right, so when trading supply and demand, we want to trade the highest probability levels. These are the levels with the greatest imbalance between buyers and sellers. In order to spot these levels, we want to see price rally and then suddenly drop without any prior warning, or price decline and then suddenly take off like a rocket. We then know that these are areas of major imbalances. So let's go to the charts and proceed with this stuff. All right, so let's look at a few examples of some zones and look at how we can find these zones, how to trade these zones, and basically how to draw the zones. We want to be able to pick these zones out and draw them, and then we can let them sit, because zones, you could have multiple zones on your chart. So let's look for a couple zones and then see what we got. All right, so I'm looking at one already. Okay, so as I said, zones could have multiple candles or they could have single candles. So you could have one candle in a zone, or you could have 4, 5, 6 candles in a zone. You don't want many more than that, because you don't want price sitting forever on an area, because then that area is not going to be what we consider a strong area. And we want to see how the market takes off from a zone. We want that market to take off hard from the zone. So you see a nice big takeoff there, and you can see this was a leg down, and then we based for one candle here, and then we moved higher. So how I found that zone, when you stop making a new high and you have a low, all right, when you have your low here and then you have a high, so it's where the market starts going sideways. You could see this was a sideways candle, because you pretty much sitting here, you could call this a zone. It wouldn't be a support, and it wouldn't be a zone that we're looking for, but you want to see candles inside of a candle, almost like this is inside of this candle. But we want to make the zone based off of the low. So we're going to mark that. So we're going to mark this low, and then we're going to mark this high of this candle here. All right, now if there was any other candles in between, it would still be this zone. So we could have 2 more candles in here, or 3, but we would look for price to come back to this zone. This is our demand zone now. Okay, so demand's going to be more like support. So now when price comes back to this zone, the way that most traders trade this is they set an entry here with a stop loss below the level. Now there's a couple different ways you could trade it. You can sit here, wait for the market to get to this level, put an alert in, and then you can look to, look for price action that leads you to trade. Now you could also set it and then let it go. Set your entry, set your stop loss, and then let the market go. So let's see what happens at this zone. This is a demand zone. You see how strong we took off from that zone. No fooling around, no little candles after we made up our mind to move. So we want to see what price does when it gets back to this level. All right, so you could see price came right back, hit that level. So that's going to be one hit on that level right there, and then the market supposedly pushed off. You could see the rejection at that level. All right, and then you had a nice little profit, and then we're going to see the level was tested again here, and then you had some nice profit and the market went much higher. All right, so that was a nice move off of that zone there, you could see. So let's move that zone in and see. You could see we like that zone, because what happened was we dropped and then we based and then we rallied. So drop, base, rally. All right, and then the market came back to that level. So that's how we found the zone. It was a drop, base, rally. and then the market came right back to that zone and hit it twice. So we had 2 hits on that level. Now you want to trade this once or twice, but after the second or third time is you're getting really risky, because you're absorbing up all of your all of your buy zones here, and eventually the sell orders take over and this zone becomes weak and the market drops and goes right through that level. So that's what you want to look for. All right, so understanding supply and demand, first of all you want to know where supply is and where demand is. So supply basically would be like resistance, and it's going to be above, and demand will basically be like support. It will be below price. Now with the zones, you have 2 lines which are called your distal line and your proximal line. So your distal line is going to be the furthest from the current price, and your proximal is going to be the closest to the current price. But we're not going to be concerned about those lines, because we don't need to make more things to make us, we don't need to know more things to make us more confused. You know, you don't have to say, well, this is the proximal, this is the distal. You don't need to know that. You just need to know the zone. But I'm going to show you both of them. So I'm looking at it, when I'm looking at this chart, I'm going to go to a level and I'm going to draw, this is going to be the first demand level, okay? And you could have multiple zones, and you normally want to make them different colors. Now to me, I can't really say which way is best, because see, I'm using this red candle here, this bearish candle, and then the indecision candle. I use the low of that candle. Now, do I want to use just the body of the bearish candle, or do I want to use the wick? You're gonna have to decide that on your own, but I tend to use the wicks. A lot of people just use the bodies, and the thing that you really want to do is you want to use the low wick or the high wick. So in demand, when you're drawing a demand zone, the lower the wick is down here, you definitely want to have that. But the wick that's above, you could use the bodies or you could use the wick. All right, so this is going to be a demand zone, so let's mark that. All right, let's mark that. And we'll make it, let's make it a little like light blue. Make it bold and 20. Okay, so that's going to be a demand zone. Now the way to distinguish, probably just make them different colors. So you change this, you know this is a demand zone, so I'll make that one blue, much like that. And let's make the background blue. Okay, and then I'm going to show you a next zone, which is going to be a supply zone. So that's our demand zone, and the lines basically would be, now you don't need to know this for sure, but this is just to let you know. Your distal line will be the lower line, and your proximal line will be this line. So just remember, the distal is going to be the furthest from price. So this is the distal, it's the furthest from the price. This is closer to price, so that's going to be your proximal line. It's the closest to the current price. So let's draw another zone, and then we're going to draw another zone. We're going to show you how multiple zones show on this chart. So when I'm drawing supply, now the reason I drew this zone here is because you could see how price stalled right here. You had the market moving down, and then we had a little couple candles sideways, and then boom, the market took off. So when I came here, the market moved up, nice move up, and then a nice takeoff to the downside. So I draw this as a supply zone. I definitely want to have, I can have either this, I can draw this a couple ways. So we're going to look at a couple of them. I'm going to draw it like this. This is the way that I draw it. And let's make it green. All right, so that's going to be a demand zone. Now you can see I used this base right here, but I made sure I had the wicks up here. Now again, I told you if you want, you could use the wick, so you would use this wick down here. but I used just the base. Now it could make a difference at times because you see I used the base and then you see price came right back to that level and then dropped to the downside. And the way it dropped like that, I want to make this into another zone, because now when price gets to that zone, because if we were trading this zone from prior, this is going to be, let's draw this out. Let's mark this. And let's make it green. So that's our supply zone. And they're going to be green, and you got blue. So you could use any colors that you desire to use for your supply and demand zones. So now you understand that the supply zone is going to be like a resistance level, and demand is going to be like a support level. So you know which one is supply and which one is demand. Now we want to trade these levels. We want to see price come back to those levels. So if I was looking to trade this supply zone, what I want to see is price come up to that level, bounce on that level just like it did here, and then we're going to trade it to the downside. Now there's a couple ways you could trade it. And if I was trading this demand zone, I want to see price come down to that level. Then we're going to trade it to the upside, right? Now I'm going to show you how to trade this naked with just the supply and demand zone, and I'm going to show you how to trade it with Ichimoku. So we got a little ways to go with this stuff, because there's some serious things you want to learn here. All right, so that's what you see. That's how you want to trade. So now we'll be looking for price to come. Now some guys just set a level. They know this is where they want to take the trade. They're going to put their entry order here, put a stop loss above this point, a little bit above the zone. All right, and then if they were going to trade this lower level, they put an entry here and put a stop loss a little bit below the zone. They just let it go, and then when price comes in, triggers them, they're good to go. Now you got to make sure you see your zones and you know which ones are good supply and demand zones. So you want to see stuff like this, strong takeoffs from that level. You could see this is only a one candle consolidation really, because price came up and came right down. Same thing here, came up, came right down. Now this is a little bit, couple more candles. So you really have 1, 2, 3, 4 candles, and then price took off. All right. So that's going to be a supply and demand zone, and that's how you draw your zones. That's what you look at for your proximal and your distal lines. You don't have to remember those. I just wanted to teach it to you so that you know it, in case you just really wanted to know what I mean. Now on here again, I could make another zone, right? So price may not come back to this level. So price may come to this zone, because this looks like a strong move off of that zone. But you could say the way it moved off of that zone also is what has me looking at it as a supply level, and it would be here again. So I could say that either price is going to come back to this point, but the way it took off of there, I might look at this level. Right? Then I may see what happens if price gets back to this level. All right, and then I can know where price is and what I'm going to do here. But that looks like if I didn't have this top level here, so let's remove this. And then I just use this level, then I would be waiting for price to come here. All right, but I like this level here, but this could be just your main level here. So we will see what price is going to do there. So you have to extend your zone. So maybe your zone goes, you know, it could be weeks before you come back to these zones. It could be a long time before you come back to that zone. So a lot of times, you know, you're not going to know. If you don't want to just set an entry, you want to put a price alert when price is near that zone. Don't put it right at the zone. So maybe you want to put a price alert at this level. So you're waiting for that. You put a price alert there. When price gets there, you know what you want to do. And then same thing down here. Price gets down to about this level. You put a price alert. When price gets to those levels, you know, and you'll see what you want to do. Now, you could trade price action signals like we have from a zone, or you could zone walk the trade, as you know about zone walking. Or you could just set an entry level and then trade it off of that level with your stop loss up here. And then you have to get confident with your trades like this, though. it's not something I suggest you just start doing right away. All right, so that's what we look at for our zones. That's the proximal and distal lines. So we're going to look at some more. I'm going to show you some more charts that have supply and demand zones, and then we're going to look at some real live trades setups. I'm going to use a Forex tester to show you some trade setups and how they worked out. So we'll look at that, and then hopefully you guys understand supply and demand and how to trade those. And then we want to look at how to trade it with Ichimoku, all right? Because you could still use Ichimoku to trade. You're still trading the bias. So if we were below the cloud right here, so let's see if we could even put Ichimoku on here for below the cloud right now. So we're not below the cloud, so I really can't show you an example here. So I wanted to show you if price was below the cloud. Now say your zone, basically, we'll get into it more when I show you some real examples. But suppose this was your zone right here, right? And you're below the cloud. Well, now you know you want to trade to the downside. This would be your supply zone. So if price was like this, suppose price did this, and these are just, I'm just saying suppose, so you get an understanding. Price moved down, stayed below the cloud, hit our zone, then we know we want to trade to the downside because we got Ichimoku signals to the downside and all that, then we would trade to the downside. But I'm going to show you some examples, and there'll be better examples based off of what it really looks like. But that's just to show you and help you to understand that you could still use Ichimoku using supply and demand. Everything that I teach you, you could use Ichimoku and do all this stuff. All right, so that's what you're looking at, and hopefully you guys like what we're learning so far, and we're going to move on. We're going to start hitting it a little bit harder, and then we're going to see what we can do, make some real trades, see what happens. All right, but again, I suggest that you really practice this stuff, really back test it, really understand when you see a zone and what a real zone looks like, because it might not be a real zone. So we're going to go over some examples and show you why I thought it was a zone. We want to understand a zone and really get to know it, because it might not be a supply and demand zone and you're marking it as one, and then you're going to lose your trades. So you want to really understand that. So we'll go over more how to understand what really is a zone and what really is not. All right, so let's move on, guys. All right, so now we want to take some time to look at some real opportunities. As the market moves, you can get a chance to really see what we're looking for and how we look at some of these zones. Now the higher probability zones will be mostly where you see like price make a move straight up, and then all of a sudden maybe one candle between, and then it drops right down to the bottom here. Now you like this kind of candle, but this makes the zone so much small, because this is, you want a candle a little bigger than that, because other than that you would have to make a zone that would be much like this. So I don't want to make that my zone. So you're looking for these indecision, these consolidation candles. Basically it would be like this. This would be a really small zone right there, so you would make that zone, but I'm not going to look at that, so we'll keep on moving. But that's basically how you're looking at your zones. Let's delete that, and we'll look for another opportunity here as the market moves. Now you see how price moved up and then shot straight down. That could be a level. Really putting your zone is the thing in here, but we're not looking at that. I want to see something clear that you can understand and that you could really learn to trade. And then we would probably think this is a level. This could have been a level. I didn't mark that, but you could see we would have definitely wanted to draw it in there, because you see the consolidation candles, and then price came right back. It dropped down, came right back to the zone, and then price dropped. Okay, but let's find a really good zone that we could look at trading, and then we'll talk about how to enter your trade. Now here again, this is another one like the previous one, the really small consolidation candles. So we see this as, an evening star, and what I'm going to do here is draw this zone, because this candle prior isn't so big. Now notice when I'm drawing my supply zones, I'm not really worried about the bottom wick. I'm more concerned about the top wick because that's going to be the top of the zone. And if I was drawing a demand zone, I would be more worried about the bottom wick and not the top. All right, so let's extend this so we could see what happens with this. So we're going to, let me change this. Let's see what we could do here. We'll change this rectangle, give it some time so we could look at what happens with price. It moved me, but that's okay. We still put it in right there. So you see on the supply zone, I'm looking more at the base and then the upper wick. So if it was a demand zone, I'd be looking at the base and the lower wick. So let's see what price does here. Now I'm going to talk about trading this if price gets back to this level. So I probably put a price alert somewhere in here. So I'm going to put a price alert like maybe right here. Let me know when price gets up to that area. And then I would have got an alert, so I would start looking. Now, if I didn't put a price alert, I would have put my price entry right here. Now there's a couple places you could put your price entry. You could put an entry right there. You could put an entry in the middle of the zone, all right, with a stop loss a little bit above the zone. So I would have had a stop loss up here. So let's put a stop loss there. We're going to put our entry at the middle of the zone. Now it's a personal choice. If you want to put your entry at the beginning of the zone, this cuts some of the zone in half because price more than likely moves back up into the zone. So you're going to cut some of your risk, okay? So let's see what happens. So price hit, we would have been triggered right here if we put our entry there. And then price is still just hanging around there. Hits that level again, and then it drops a little bit. And it hits the level again. It's starting to get weak when it hits this. It starts hitting this many times in your zone. Because you're absorbing up all of that supply. And you can see price just drops to the bottom. Would have had a nice trade here. We wouldn't have got triggered if we would have put our entry in the middle of the zone here. And then let's see what happens, how long this zone is going to hold out. Because eventually this zone has to get weak because you're absorbing up all of the, you can see nice trade to the downside. So putting my entry order in the middle wouldn't have really worked here. I would have had a better entry if I would have put it in right at the bottom of the zone. Now, like I said, that's going to be your preference, so you may miss a trade like that. So we would have missed this if we put our entry here. Now, if we would have put our entry where I said in the beginning, we would have had a nice trade. Probably would have got out here because, then you would have saw price come back again and then finally hit again and then drop it. It really missed the zone here. You just missed by a little bit, and then the market drops to the downside. So let's see what the market does, if it's going to honor that zone. I think the zone, you have absorbed up all the supply here. And we hit that zone again and drop a little bit. And now it looks like we broke through. Now it's more of demand because you absorbed up all the supply. All right, so that's looking at one trade. So let's continue to look at some other opportunities. So we're going to look at some more opportunities, see what we see here. Now, you could probably find some spots throughout here. I don't like to look for spots when it's really messed up like this. I like to see the market moving or a level, where you can tell better. I mean, a lot of people can pick out some areas in here, but we're going to look for better opportunities here. So we're going to look for, okay, so this right here, most definitely, the market was moving higher. Now you did have a market come down and then take right off, and then you came back. But what I'm looking at is this right here. You see this leg here? Well, all of a sudden price dropped here, but then shot off. Look at the big candle that took off here. So what this would be, basically would be Do I have a drawing tool on here? Let's do it like this. This would basically be a rally, right? And then this one candle base and a rally. All right, so this would be a demand zone, right? Because what you would be doing is looking for price to come back to that zone. All right, so that's why you would call that a demand zone. All right, let me see here. Let's put the zone in here. So this zone, you're going to just cover up the whole candle, this one candle, and we're going to look for price to come back. So we'll put our entry, we'll set an entry here. You can put a stop loss a little below the level. Now there's other ways to trade this also. So let's see what happens if price gets back to it. We'll talk about other ways to trade these zones too, instead of just setting an order in the middle or at the top. All right, but now if we set an order here and we had a stop loss a little bit below the level, we're triggered already. And then price makes a nice move, and that's a good trade. All right, so you would have had a good trade off of that level because this was a strong, very strong demand zone. Price moved higher, then you had a base, then price moved higher, and then came right back to that level. When it came back to that level, this would be like your support level, which would be more demand. All right, but we don't call it that support level because we're looking at supply and demand the way the market took off of that level. Why would we say this is the demand level? Let's move in here. Because guys, the market doesn't just make a big move like this. It takes a lot of volume. It takes big institutional traders to move this market like that. All right, it takes money to move this market like this. All right, so if that's where the money was, right there. All right, and you saw that, boom, it took off. So when it comes back to that point, we expect the same thing. That's where the money was, and that's where the money remained, and you can buy again because that was a strong demand zone. So you can buy again. So I would trade this at least twice. I mean, your zones you could trade more than once, but I don't really look to trade them 3 times. I mean, you could. So we did get this one trade. So let's see what happens if price gets back to this level. And that was a strong drop right there. That could be a supply zone there. Really strong drop. And another level which could be a supply zone would be another level like this. You could look at that. So you could have multiple zones on your chart. You could put zones in here, right? And we're still waiting on this zone. We would look at this. Now all zones aren't going to work out, but we could have these in here. Then I would probably mark this level here, and I would mark this zone like this. Mark it much like that. And so I would be waiting to see what happens at these levels. Now I'm not going to confuse it with all these levels here, so we're going to focus on what we were already looking at. But those are some zones that I would be looking at, especially up here. That would look pretty much like the one we just entered in. But will that level hold? We don't know if these levels are going to hold. Now the market's back on that point again. It didn't violate our level. It came right back to the level. Now if you had an entry in the middle, you would have been safe again. But why would you? The zone wasn't that big, so you could have traded this normal. It looks like you would have had another good trade. And you could see the market moved and continued to go higher. Now where I said this was another zone here, let's see if it would have held, because this was going to be I would have marked this as a supply zone right here, and then price would have came up and didn't really hit the zone and dropped. We just missed the zone. So sometimes you'll miss these zones, and then it dropped and then it violated the zone. But we had a nice strong move off of this level here. So we had 2 good trades off of this demand zone here. We saw this nice move, then you saw this here demand zone bounce, and then another bounce right here, and then the market moved to the upside. So you would have had a good trade there. That would have been 2 nice trades off of a demand zone here. And again, this was going to be this was called a rally, base, and a rally. All right. So let's look at some other opportunities. All right, so we're going to look at another opportunity we find here with the daily time frame of the euro US dollar. So the main time frame that you want to use is the daily time frame, but this works on all time frames. But as normal with the higher time frames, it's going to be more reliable using a daily time frame, okay, as opposed to you know, an hourly or something like that. But that's not to say those time frames don't work. It's just to say that it's more reliable to use a higher time frame. And that's with most of the trading things that we talk about. So let's look at some more opportunities. See, you could see right off the bat this opportunity right here. All right, so the market was moving higher, and then the market dropped. So you had a little drop here, and then you had a base with two candles, and then look how hard it exploded off of those two candles. All right, so we're going to mark this as a zone. And I'm going to use this whole base. I'm going to use this whole, since the candles aren't that big, I'm going to use this whole thing as my zone. And you'll get a feel for how to really draw your zones. Whoops. 2020 we're going to extend it to, right? So we extend it to 2020, hit apply, and then let's see what happens with this. We're going to put our entry order. We already know, so we're going to go to sleep, put our entry order in. We're going to forget all about this pair. I put a stop loss down here. We're hit already, triggered already. Now this again, this is a demand zone here. The last one, couple that we've been looking at have been supply zones. So you could even look at this might be a supply zone, but the second candle wasn't that strong off. This is a demand zone, so you could see we already got triggered into the trade. Let's see what price does here, and price takes off. You got a nice trade. Let's see if we could get a second hit on this. And we did get a second hit, but then the market didn't really go much higher and it dropped to the downside. So that would have probably been a losing trade if we've taken that. Well, I mean, you got a little profit, but you would have probably had to figure out how to save that profit without taking a loss after a massive drop right here. So you could see a nice move to the upside, real strong move to the upside. And after you had that drop, base, rally. So this is a drop, base, and a rally. All right, and then we entered on this demand zone. This would be demand. So demand's going to be like support. So you're going to be buying here. So you put your entry order in. So you're looking for your, as I back up here. All right, so you see this ahead of time. You know, you see this now. You know, it didn't matter if you saw this right there, right here, right here, or right here. You see this zone down here because of the way it took off. So you have time to put an entry order in here and a stop loss, and then let your trade go if you get an opportunity. The main thing is going to be learning to trust these trades, to trust these setups. All right, and then the targets that you're going to shoot for, to me, I shoot for the next support and resistance levels. All right, so we'll just shoot for something like this. And you could see it's starting to be like a range, so you could see that would have been a good level to shoot for. And yeah, this is hindsight, but that's where I always would shoot for. I mean, my first level would have been more than likely this point here. And then I would have started to look at this level, because we do this all the time, shoot at for support and resistance levels. So we would have shot for that point and then next here. So the market hit that level. It looked like it was going to drop, but it did make it to the top point here. And then the market moved lower, because it's a sideways market anyway here. And you can see this looked like a support level here, and then it got violated. See what happens here, and the market drops right to the downside. So does this look like a supply zone now somewhere? I don't like the way it would set up, so maybe this level right here coming off of this point, I would have looked at that as maybe a zone. So I would have looked at this as a zone here. let's see if the market comes back and honors that level. And nice takeoff there. This could have looked like a demand zone here as the market moved higher than you, but you could see it wasn't honored. But then see that level that we talked about. So let's back up here. That level that we said, once this zone got violated, all right, so let's back it up. We already looked at this trade, so we took this trade here, and then the market violated. But as it violated, a lot of times there's demand in these areas, and then you could look and see, and that was the level right there, because look how strong it took off. It did the same thing here. So even if you started a zone there, so let's delete this stuff. So this was our zone, and now we're going to change our zone to this. Now we're looking at that. So that's going to be my, now I'm looking at this as my supply zone. Before we had a demand zone here off of this, but now I'm looking at a supply zone off of this big drop here. So you had a rally and then a drop, a rally, not really a base here, that's the thing, and then a drop. You really want to have that rally base. You want to see a base. So we're looking for price to come back to that zone because of that big drop there that we see. So we're going to look to honor that. Now the thing is learning to trust those levels, and you could see the market drop. You would have made a profit on that trade. Then the market broke through. All right. So I would have left everything else alone, start looking for something else. All right, but that's the one thing is you're going to learn to trust your trades, to learn to trust this, the setups. You know, best thing is the back test. And then you're going to have times where it works and then times where it doesn't. But when you really could pick out these zones, that's when it's going to really work for you. All right. All right, so let's look at a few opportunities on the real live charts right now. We don't have anything to show that we could trade at this moment, but there are some zones that we could set up to look for future trades. Now there's a couple that I'm looking at here. First, I'm starting off with the US dollar CAD. So let me mark these zones for you. The first zone that I see is basically this zone right here. You see the market moved down, and then we had one candle based, and then look how it shot up off of that level. So I would mark that level, and I'm going to make it and you can see what already happened. So I'm going to make this blue. So you would see that coming off of that level there, price came back, bounced off of that zone once. All right, so you could see why I marked it. We had a monster move off of this level where we based one time. You're bearish, and then you're all of a sudden monster bullish. All right, a big bullish candle like that, it takes volume and it takes money to move the market like that. You know, I would even have looked at something like this level here. You know, you can have a lot of zones on your charts now. So maybe if I put another zone here, and I wait on this zone. So I could wait on this zone, and I put that in. So if we put that in, and let's position it for 2020. And then let's change the color to blue. All right, so we could have that on our chart. And then we found another zone above that, which would be this one. All right, and then you could see how price came back and hit that zone a few times. This zone has been hit. We made the zone here, and I probably wouldn't have made this a zone because you did take off nice, but the very first candle wasn't super strong like you see here. I would have made this the zone here, and then you could see we have one bounce right on the top of the zone, and then the market went higher. Just missed the zone the second time, then this third attempt really went inside the zone, and then the market moved higher, and then you had another hit, and then the market really took off of that level. Not really took off, but made a big profit off of that level. All right, so you could see that. So that's what I would be looking at. And I'm saying you could have a couple zones on your chart. This is what they call fresh zones, are new zones that haven't been hit yet. So this zone hasn't been hit yet, so it's still an active zone. So you pretty much have active zones that haven't been hit. I'm going to remove this, and this would be where we would be looking now, because we've already exceeded that other zone. We haven't hit this level yet, so it could be some time before price came down to that zone. All right, so let's go on and look at a couple other pairs. We'll go to the Aussie Yen and look at that. All right, so we're looking here at the Aussie Yen daily time frame. There's a couple zones on here that we could be looking at. So like I said, you don't have to have just one zone, because you could be looking at multiple zones. All right, so what I'm looking at here is a couple levels here, but the main one that I'm concerned with is, first I see this level. All right, because the market moved up and then it made one base candle, as you could see right here, and then a drop. So it's a rally, base, and a drop. So we would put our zone, and you can see what happened with the zone already. All right, and the market moved, came back up to it, dropped, had another good trade, 2 good trades off of that, 3 good trades possibly. But the thing is, you got to learn to trust these trades. So learning to trust these trades and take these trades, the way I would do it is, guys, I would use my live account, but I would use a mini lot. Just open one mini lot, and make these trades. Set up your zones and have entries set on them and see how it works. See if you're setting up your zones well, because the thing is to use real money, because using real money is going to help you to build that mentality to be able to trust these trades. Because if you're taking these trades on, on a practice account, what's going to happen is you're not going to build confidence, because you're not risking anything. And then when it comes time to really risk stuff, you're going to be afraid, because you haven't really done it with real money to build that temperament that you need. All right, so but you could see what I'm looking at. When I drew this zone in, I really would be more concerned, since the candle was so small. I really would put it at the base right there, but the candle was small body. I used the whole wick. Now usually on supply, like I said, we would be concerned about the upper wick. When you could see what happened here, boom, came right to the zone. We overloaded the zone right there once, but you had nice 3 hits on there, and the third hit really dropped. And then the next one I would be looking at is kind of weird, but I would even looked at that, but see, that was already part of a zone. So I wouldn't have, probably, if I looked at it in the past and didn't notice, I don't know if it would have held stake. But looking here, you could see this. And I'm looking at this because of the way we had a monster drop here. You had a big green candle and then a big red candle. It takes a lot of volume, a lot of money to move the market like that. So I didn't want to draw my zone this way, because that's the way I would have had to with that green candle. So I put it up on the base, the top, and I used the wick. If price gets back up in that wick, that's where all that selling pressure is, and that's the supply zone. The market drops to the downside. You could see it hit here, and then looks like it would have been violated this time. Let's pull it over. Yeah, it would have been violated. So you had a good trade off of it once. And again, it's learning to trust these trades. It's going to be the hard part, learning to trust these trades. All right, so let's move on. We're going to go to the Aussie US dollar. So we're here with the Aussie US dollar. We're going to look at a few things. I see one level right off the bat coming here. We're going to work our way to the front and look at some of these levels, what we would have looked at. But there's some active zones right now that we could set up for trades in the future. So pay attention to this. Hopefully I get this out while this is still active. But anyway, I like this level here. All right, I'm going to mark that, hit OK. and I'm going to put it at the base here and then the wicks up here, because you had a drop, base, and a drop. And then look what happened. The market came back once. That's one hit right there. All right, so that one hit, that was your trade, big trade to the downside. Another hit, drop to the downside. Another hit, drop to the downside. Another hit, drop to the downside. Another one to the downside, and then another one, and a big move to the downside. This zone was really exhausted. This was a great, fantastic zone right there. Haven't really seen a lot like that. That was a real strong zone. And being able to find those zones, I mean, it's just this little move here, but you can see how big this was here. That's what signifies it. And then most people might have gotten into the point where they put it here because they saw that big move. And you wouldn't have been wrong, because what would have happened is if you didn't mark this, you would have marked this level here, and the market drops and then comes right back into that zone again and then drops, which was still part of this zone up here when we hit there. All right, so you had the market drop a couple times for you just using this zone, because these zones were so close, you know, because like I say, on your chart you could have a few zones. You may have even had both of these zones drawn, and I don't think I would have had both of these in here overlapping that much. All right, it's too much for me. I would have just looked at that zone or that zone. Now, we do have some active zones here right now. What I'm looking at right now that is active, and they haven't been hit yet. We're going to make these different colors. So let's put in new zones here. So we draw the upper wick, and then we use the base on these supply zones. So we'll make it blue, and we'll make it 2020. All right, so that's one zone. That's one active zone, because you have a rally and kind of not really base, but you flattened out, so it's like the tweezer top and then a monster drop. All right, but then there's another zone that I see, because first you have a rally, then you call it a base and then a drop. So that would make that supply zone here. And then I see another supply zone, which would be the drop, base, drop. You're basing right here. So therefore I'm going to mark that, because I'm going to use the whole, these candles are not real big body candles, so I'm going to use the whole thing here. Now this is active and it already hit. So you could see why I would have drawn it in the way that I'm doing it. The thing is, you have this here, drop, base, drop, and then you could see the market came right back to that level and then dropped to the downside. But we still have a fresh zone up here, which would be an active zone that's still active. All right, so you could do a lot of things to let you know. If you knew that you already, this was a, say this is an active zone, you can make it green. And then if it was a zone that's been hit once, you could make it, you know, red. And if it's been hit twice, you can make it yellow. So whatever, so you know what color your zones are, or else you could just have a color for supply and a color for demand. All right. Okay, so but if I'm trading this, and if I'm looking at Ichimoku and I'm looking how to trade this with Ichimoku, there's a couple ways you could trade this with Ichimoku. So we have these active zones in here. These are supply zones, which means we're going to be trading to the downside. We're going to be shorting them. So we're going to put Ichimoku on the chart. All right. So with Ichimoku on the chart, you could see when we had this zone right here, every signal for Ichimoku is to the downside, right? You could see price came back into our zone. We could have traded that zone to the downside based off of being inside the supply and demand zone. Well, basically this is a supply zone. So the market moved back up, found supply. Ichimoku signals are bearish. You got a TK crossover, that's bearish. Price is below the cloud. Your future is dark. Everything is bearish here. It's the line is in alignment the same way that Ichimoku is moving to the downside, a bearish move. So you're looking for that supply, and the market hits that supply level here. You could have traded that. You could have looked at that. You could see where Tenkan-sen is, where Kijun-sen is. You could put an entry there. You could have put your stop loss above the zone. You could put a stop loss above the cloud, but you could see that supply zone is letting you know that that's where the market's going to drop to the downside, and Ichimoku signals are telling you the exact same thing. Okay, so that's what we're looking at. That's how you trade this with Ichimoku. So if you're looking at demand zone, you would be above the cloud trading to the upside on a move to the upside. So let's look at a few more opportunities. We'll go to the Euro CAD. So actually not the Euro CAD, we're going to look at the Euro Pound here. We're looking at this with Ichimoku, so the market's moving to the downside. Now this is past already, so it's not going to be active right now, but I'm showing you what I would be looking for, and it's going to be the same thing that you're going to look for if you were not using Ichimoku. The market's moving to the downside. I would have looked at this zone right here. Alright, you can see you got a zone here because the market dropped base for 1, 2, 3 candles and then a monster drop. Alright, we're below the cloud, TK crossover, everything's bearish. So this supply zone tells us to trade to the downside along with Ichimoku. You could see why I would mark this. This is a drop, base with 3 candles and then a drop. The way we leave that level with the big monster candle, that signifies that we like this level. So what happens is the market comes right back to that level and then drops again. Now had I not caught that, I see another level here. You could look at this right here. See this move to the downside here? Well, the market pretty much, you got to move to the upside, then a base, then a drop. I could count that wick in there and use the base. Then the market came right back to the bottom of the zone, right? Hits that zone and then drops to the downside, all in the line with Ichimoku. All right. And then you can see we didn't quite get back to that level again. Probably could have looked at this as another level here. Marking these candles. Then you could see the market came right back to that level because you could see the way we leave a level. And then the market came right back to those levels. And everything is in line with Ichimoku. And look at it, hits once, twice, 3 times. All right. And then I wouldn't look at this level per se. Because of the long wick, I don't really like that long wick on this. But I do like the way it moved away from it. But the long wick, more than likely just then a big news day. So that's looking at trading with Ichimoku, how you would trade. Let's look at a couple other pairs real quick. So we're looking at the US dollar JPY. This will be the last one we look at. Then we'll end this session. We'll break it down with a couple little things and then we'll get out of here. All right, but looking at this, everything's bullish. So if you find a zone now, you should be looking for a demand zone, but you still would mark your supply zones. But if you see a demand zone, and I would look at this level where you see the market, the first thing I notice is the way the market leaves a level, and then I look to see if it was a level where it was basing, and it did for 2 candles because we moved up, rally, base, and then rally. Now we only had one big candle move there though. That would concern me. But if I mark that base, I will mark it like this. If I mark that zone, it would be just like this. You can see that level, and then the market came right back to the zone and then took off. All right, so that's definitely how you would really want to trade these. Now the thing is, you want to trade the level, you want to look for price action. You look for price action off of the zone. It's going to give you a bigger stop loss. It's going to give you a trade outside of the zone. That's why you want to trade the zone. You don't want to, if price action happens down at the bottom of your zone, that's good. But when price comes right back to your zone and then leaves, you want to get that level. All right, so that's where you got to build the trust to take these trades. So you got to build up that trust with this. I mean, because this is kind of like, oh, do you trust this? There's nothing that you really see to solidify this for you. You just have to see this happening. All right, so that's going to be it right now. That's going to be the end. We'll look at a couple other things and then we'll close out this session. All right, so let's continue on. All right, so this is going to end our supply and demand unit. I'm having a feeling we'll probably see more of this stuff, and we'll probably expand more on the unit and the course as far as with supply and demand. But we want to get through this course and put it all together and show you how to use everything together just to have a strong, solid foundation when you're trading. So that's going to be it for now. Hope you guys enjoyed. Continue learning, continue studying, and figure out which works best for you of all the things that we do, and put that together and stick with it. Once you stick with something and master it, your trading will take off. All right, guys, have a great one. So long. God bless.